Hi everybody, and today we will talk about who owns Bitcoin, who mines it, who is breaking the law. Okay, let's start it. Everyone seems to have an opinion on Bitcoin, the original cryptocurrency. Some say it has revolutionized financial access. Others call it a threat to financial stability, citing roller coaster prices and illegal behavior. But no matter what you think of Bitcoin, interest in it is higher than ever. Bitcoin was the first cryptocurrency and it's still the biggest today with the highest market cap. Almost $1 trillion now, said Anthony Sor, a professor of finance and entrepreneurship at Mid Sloan. It's basically bigger than the next biggest 10 cryptocurrencies combined, despite being in existence for more than 10 years. There are still many open questions surrounding Bitcoin. From the identity of its biggest investors and the location of Bitcoin miners to the structure of the blockchain ecosystem that underlies the cryptocurrency. Amid calls from industry participants for even wider Bitcoin adoption, either as a public investment vehicle or legal tender. Sir teamed up with Igor Makarov, a finance professor at the London School of Economics and Political Science, to shed some light on the Bitcoin ecosystem. A better understanding of the Bitcoin network and its participants should be the basis for any decisions about how to integrate these new cryptocurrencies into the traditional financial system. The pair write in their new working paper Blockchain Analysis of the Bitcoin Market. Analyzing the Bitcoin network. Bitcoin and other cryptocurrencies offer a decentralized system of payments and store of value outside the traditional nexus of governments currently. The blockchain technology that underlies Bitcoin replaces the reliance on a few centralized record keepers, such as banks or credit card networks, with a large set of decentralized and anonymous agents. A typical Bitcoin transaction contains a list of senders and recipients represented by pseudonymous addresses, the number of Bitcoin sent and received, and a timestamp of the transaction. Sora and Makarov used public and proprietary sources to link Bitcoin addresses to real entities to build a database documenting the evolution of the Bitcoin market from 2015 to 2021. They download blockchain data using the open source software Bitcoin Core and used the block key analysis tool to parse raw data into individual transactions. The researchers then developed algorithms that used the semi-public nature of the Bitcoin blockchain to extract information about the behavior of Bitcoin's market participants. Doing so allowed them to analyze transaction volume and the network structure of the main participants on the Bitcoin blockchain, document the concentration and regional composition of miners, the people who verify the legitimacy of Bitcoin transactions, analyze the ownership concentration of the largest holders of Bitcoin. While the research itself is specific to Bitcoin, somewhat the authors found also applies to other cryptocurrencies. Here's what they learned. First, illegal transactions are a small percentage of overall Bitcoin activity. Because the Bitcoin blockchain is a public ledger, All payments flowing between addresses are observable. However, some Bitcoin users adopt strategies to impede tracking by moving their funds over long chains of multiple addresses and splitting payments. The authors developed algorithms to filter out this spurious volumes so that they could trace economically meaningful payments between real entities on the Bitcoin network. In doing so, the authors found that about 80% of Bitcoin volume in an average week can be traced to exchange from Kraken to Coinbase. For example, or exchange-like entities such as online wallets, over-the-counter trading desks, and large institutional traders. While many have worried that Bitcoin's price has been supported by illegal transactions, Shore said illegal activity is just a small fraction, 3% by the researchers' estimation of what actually goes on in the Bitcoin blockchain. This doesn't mean that illegal activity isn't problematic, Shore said. It's just saying that demand for illegal activity cannot be supporting the Bitcoin price because it's such a tiny fraction of what actually goes on in the blockchain. Second, Bitcoin ownership is concentrating among the rich. The authors found the participation in Bitcoin is skewed toward the elite. The research showed that at the end of 2020 there were 1,000 clusters controlling 2 million bitcoins. The address clustered addresses so that all addresses that send bitcoins in any single transaction were redeemed to belong to the same entity. Shore said this often happens for the sole purpose of obfuscating the origin of funds. In addition, the top 10,000 clusters owned more than 4 million bitcoins, about a quarter of all outstanding bitcoins. This has important implications for market stability. Somebody who can easily spend $100 million worth of Bitcoin and sell it or buy can have a massive price impact in the market, Shore said. That's typically a situation we don't like because it means a regular retail investor. You might suddenly find yourself percent down because of massive volatility, which might be created by a few large investors randomly deciding to sell some of their holdings. Thank you everyone for watching this video. Bye.